You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Nervous?
Yes.
First time?
No, I've been nervous lots of times.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor Doug, and on today's show, big news from Robinhood. They're getting into, wait for it, financial planning. Industry experts say this will shake up the world the same way that Robinhood claimed to shake up stock trading. Even though M1 Finance had already done that. But good news, Robinhood rarely lets the truth get in the way of a good story. But regardless, what does this mean for financial planning? How is the world of advising changing to meet the times? We'll dive deep into what you should expect from a financial advisor on today's show. But of course, that's not all. We'll share a TikTok minute sure to make you think and answer a question from a stacker who said, hey, I'd better call Saul. See hi and OG. What's the question? You'll have to hear it with us. And now, 2 guys who used to run a chicken dating service, but they had trouble making hens meet. It's Joe and OG. I'm just going to go over here and cry.
Hey, everybody. Welcome to the Stacking Benjamin Show. I am Joe Saul Seahigh, and it is Wednesday, and we are giddy. We're so happy to be here with you today, so sit back and relax, because we're talking all things financial planning, because OG, Robinhood, the company that takes from the poor and gives to themselves, is back in the news. It's fantastic.
So excited.
Just headline a minute. It's like the company that keeps giving. I'm like, oh, we don't even have to prep for Wednesday's show because Robinhood does all the planning.
I think I know
for
what
us.
This one is. I might have caught this one.
This is pretty fabulous. How are you this fine Wednesday? Did you really, after we got done recording, it looked like you were seriously excited about getting it on with Cyber Monday? Like you're going to put on some Barry White, light a candle, and go shopping.
Well, I mean, I don't play favorites. I feel obligated to shop on every day of the week, regardless of any specials or sales or otherwise. You know, I'm not motivated by social pressures. I shop all the time. So I don't have to wait until the last minute.
It's like Breaking Bad. I am the one who knocks. He creates the social pressure. He's the one starting the ball rolling for the rest of the economy.
It's keeping people employed. That's my goal.
I'm not some kind of person waiting for a sale to buy.
I'm very altruistic. I don't know if you guys know that about me or not, but I want to keep people working in their jobs. So I do that by buying their stuff. Lots of it.
The economy.
The economy rolls through me.
We call it the OGP.
Right.
OG domestic product or OGDP.
Yeah.
Jerome Powell calls me and goes, how's it going? And I go, ugh.
What are you thinking about next quarter, OG? You going to keep this thing afloat another quarter? We're going to lower interest rates for you to make sure that you can make it happen. It is the holiday season, and we've got so much to talk about today. Before we get to any of that, though, I mentioned at the end of Monday's show that I will be at Retire Meet in Seattle. I wanted to give you that. We'll give it again here at the end of the podcast. But Retire Meet, the guys at Talking Real Money's conference they put in Seattle every year. You'll see other guests there too. Paul Merriman's there every year. And it'll be fun to hang out with Don and Tom from Talking Real Money and Paul Merriman, and hopefully you come out and see us, Stackers. We're also going to do a meetup around them. We'll have more details as we get closer about the Stacking Benjamins meetup, maybe the night before Retire Meet starts. Make sure you sign up for that because tickets are limited, just like they are for our New York City event. And that one, stackingbenjamins.com/NYC, but that one might be sold out even as I say this.
He didn't invite you or me to either of those, Doug, did he?
You guys can come.
Nope.
Tom and Don, happy to have the entire Stacking Benjamins team there. It'll be super fun. Great show today. We're talking about financial planning and what is the future of financial planning? And is it Robinhood?
No.
I bet you can guess. If you listened to this show before, we may think not. However, we can talk about financial planning for the modern times. But before that, we have a couple of sponsors that make this show go. So we're going to hear from them so that you don't have to pay for it and we can keep on keeping on. And then into our headline. In business, there is no room for guesswork. Every shipment matters. Every deadline counts. And when you're trying to keep operations running smoothly, the last thing you need is uncertainty. That's why reliability is at the core of USPS Ground Advantage. From the moment your package is first scanned in, it moves through a secure nationwide network, aiding in a timely and accurate delivery. You get near real-time tracking so you can keep up with your shipments. And with affordable upfront pricing, there are no hidden fees or surprise surcharges to throw off your cost sheets. It all adds up to predictable deliveries you can depend on, because knowing your logistics are handled lets you focus on everything else, your customers, your team, and the future you're building. Visit USPS.com/Ground Advantage to start shipping with confidence. USPS Ground Advantage. We mean business. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamins headlines.
Big news from Robinhood. This is written by Rob Burgess at financialplanning.com. Financial-planning.com is the website where financial professionals kind of dive into their news. And today, the reason why I bring up this headline in the first place is we're going to take a look at this from an industry insider perspective. You know, we often talk about, hey, what would it be like working with a financial planner? What are financial planners actually worried about? And right now, we're seeing a little change in the industry. Rob writes how Robinhood's trade PMR acquisition changes the industry. Online brokerage Robinhood Markets announced a couple weeks ago it had agreed to purchase the RIA custodial and portfolio management platform Trade PMR. Expected to close in the first half of 2025. The deal's for about $300 million in cash and stock. Citigroup advised Robinhood on the deal, while Lazard advised Trade PMR. Through the acquisition, Trade PMR's advisors are going to have access to Robinhood's clients who tend to skew young. Based in Gainesville, Florida, Trade PMR has over $40 billion in assets under administration. Its team will join Robinhood. We're going to dive more into this piece. But first of all, let's talk about what exactly is going on here, OG. For people that have been living under a rock, I think even they know that Robinhood has a very young customer base, not all that savvy because they don't think about the fees or the fact that the company has a history of not being friends to their investors. But now they purchased this RIA custodial and portfolio management platform. First of all, what is an RIA? What is an RIA custodial and portfolio management platform?
Easy for you to say, huh?
So easy for me to say.
So, what is it again? What's a platform of some kind?
Portfolio management platform.
Trade PMR is a RIA custodial platform, like you said. It'd be like if somebody bought Schwab or somebody bought Fidelity. Firms like ours or investment advisory firms that have, regular clients use Trade PMR as the platform where the client money is. So we use Schwab. Some people use Trade PMR. Some people use Fidelity. Some people use Altruist, which is a newer one. Some people used to use TD before it was acquired by Schwab. Some people use Ameriprise. Some people use Edward Jones or Merrill or Morgan. The place where the money is, basically. Custodial platform is the place where your client money is. And it's really important.
Good news, by the way, about these platforms, for somebody who's brand new to this, why do you have that platform? Well, I would think to some degree, this would make it harder for a Bernie Madoff situation, I would think, because the money's not with OG. The money is with
money's at
Schwab
right.
or Trade PMR or whoever it is.
Yeah, this is one of the safeguards that you put in place, both as a consumer, but also as an advisor. The third-party custodian allows the clients to have access to all their money all the time. And then the advisor who you hire has access to the money some of the time for trading, for example, or to do things that the clients instruct. So that's just one of those layers of safety that you want to make sure that are there to avoid the Bernie Madoff thing. Surprisingly, you think, well, nobody would do that anymore, right? With Bernie Madoff. No, it still happens. There's still companies out there, still people out there that are doing it the wrong way, but a lot fewer and far between.
Robinhood clients, if somebody is listening and for God knows what reason is still working with this company, Robinhood clients.
There goes that sponsorship opportunity.
Robinhood clients, it says, are going to now, it sounds like, be solicited by Trade PMR based advisors. So if you're with Robinhood, I think you can expect a whole new level of advertising coming your way, OG.
Again, not any different than anybody else. So Schwab and Fidelity particularly are known for this. If you have a retail account at Schwab or you have a retail account at Fidelity and you don't have an advisor assigned, they are going to make sure that you know that that's an offer for them, right? They're going to say, hey, by the way, we have professionals that can help you with your investment management or help with these other sorts of things. Schwab and Fidelity also have referral opportunities to outside firms. We have a partnership with Schwab in that if somebody walks into a Schwab office and says, I really want to work with a local advisor, I want to work with a person, not just, an 800 number or, one of your client service reps in the home office. I need a person. Schwab will say, here are a few firms in your area that we partner with and that we'd, they don't say recommend, but that we partner with that you can do your due diligence on. And here's 3 firms. And then Schwab makes money as we make money because they say, hey, we just split the client fee with you. We provided you the lead source and now you do the financial planning work or you do the investment management work and we split it with you. So very common organizational style in the advisor space right now. So I wouldn't expect, if you were a Robinhood investor, I would not expect an undue amount of solicitation, but you'll be made aware that there are professionals that you can engage outside of the DIY platform of Robinhood. And if you're a client of an advisor who uses Trade PMR, I don't think that you have to worry about getting Robinhooded in terms of like, I don't think you're going to be on their platform because Trade PMR has their own. Why would they transfer all the money?
Just Robinhood's going to be plugging into the same platform they've already been used. You're not necessarily plugging into Robinhood. A lot of this piece focuses on young investors and the fact that now younger investors are going to be approached about financial planning at an earlier age. I don't know that that's necessarily a bad thing. I think that might be a good thing.
Well, I think if you look at like the traditional model of financial planning and wealth management, it definitely skews older and wealthier, right? I mean, at the end of the day, advisors have only their time available to them. And so if you say, well, would you rather have 10 clients that have $100,000 or one client that has $1 million? I'd rather have one that has $1 million because now I can do that 10 times and I have 10 times the business size or 10 times the revenue or whatever the case may be. But the reality is that there's a gap there between people getting started and those people that are at $1 million or $2 million or whatever the number is. And I think more and more companies are figuring out ways to scale down to be able to advise profitably those types of relationships, the people that are just getting started. And there's tons of firms out there who do this. Facet comes to mind as a financial planning company who focuses on I mean, certainly they have lots of clients all over the board, but certainly skews probably a little bit younger in terms of their planning style. I don't know. I feel, as I think about it from a planner standpoint, why would I want to wait and not help somebody who's got $200,000 or $300,000, and has resources available to save and to invest and wants to do it the right way? We have to have a way to say, you can engage with us. It makes sense for you in terms of a cost standpoint. It makes sense for us in terms of a revenue and expense perspective. But I want you to be on the right path from 200K to $1 million, not just wait for you to get to $1 million and go, oh, geez, you could have done that way better if we had helped you 5 years ago. You know what I mean? That's kind of a weird, I don't know. To me, it seems like there has to be a path for that. And I love the fact that, I'm not going to say Robinhood because I'm not in love with them, but I love the fact that firms have ways to engage with people that are just getting started. And that doesn't mean it's free. It doesn't mean it doesn't cost anything, but I think firms are not moving away, but adding adjacent opportunities for clients to engage with them, whether it's an hourly rate or a monthly type of financial planning engagement or some sort of way to say, well, you don't have $1 million. I can't help you.
Sorry. Yeah.
And that was 10 years ago, that was the thing. And now it's like, well, I can help you, but we got to do it a different way. And for some people, that's the best way because, they have a lot of income and no assets, or all their money is tied up in their company stock or whatever the case may be. Those people need financial planning help too, to the extent that they want it. So let's have a solution for that.
It's funny that you say people with $100,000 or $200,000. I know we have a lot of stackers that aren't there yet. And people are like, whoa, OG is, how come he's not going to work with people with less than that? Here's the thing. I think when you're first starting out, I think the entire CFP industry, tell me if I'm mistaken, OG, isn't really set up for you. What is set up for you are things like budget coaches, like our friend Lacey Langford or Jen Hemphill, like people that are into coaching about getting the basic fundamental things in place, get that budget together, get the savings muscle working like Jackie was talking about on Monday. Like those are much more of a budget coach or a money coach than really what the certified financial planning industry focuses on.
Well, and a shameless plug, maybe I'm out too far in front of my skis here, but a little shameless plug for what you and I are working on, right? We're trying to create that kind of middle of the road beginning stages. Like, I'm not ready to hire somebody and, go all in yet, but is there a solution for me somewhere in the middle? And maybe sometime in the late spring or early spring, we'll have something to kind of fill that. But yeah, I mean, I look at it when I talk to people, and I love, I talk to everybody who calls. I look at it from a value standpoint, and say, is there enough value here that we can provide that offsets what we charge? And we have a business to run, and it has payroll and expenses and so on and so forth. So I have to be cognizant of that. But if you're saying, should I pay a planner $5,000 a year, or should I put that $5,000 a year in my Roth? Should I pay a planner $5,000 a year, or should I work on paying off my credit card debt or my student loans at $5,000 a year? I think the right answer is keep it simple on the investing side and on the decision-making side, and do the things that have the biggest lift. The biggest lift for somebody getting started is probably not to pay an advisor $5,000, but it's probably to say, if I have this $5,000 to pay, I should probably put this on my credit card debt, or I should probably put this in my Roth, because that's going to have a bigger impact than an advisor would right now. Now, as that grows, as you add some complexity around taxes or multiple rental properties, or, whatever happens in your life that adds complexity, now you start thinking about, well, am I getting a tax benefit, or am I getting a better organization with my money, or better investment returns, or better decision-making? That's where you have to decide whether or not, there's value there. But early on, I don't think that it's a CFP thing necessarily. I look at it from the perspective of, would this money be useful for this person in a different manner?
Right.
In terms of the payout. What's the payout?
Yeah, that's what I meant, is that, you've got these areas that financial planners cover. And as you accumulate assets, the estate plan gets more complicated. Maybe the tax plan is already complicated, but that balance sheet becomes filled with things that become like a garden that needs to be weeded. That's a whole thing that somebody starting out, you can stay away from. But I don't think that having the CFP capability of like working on the efficient frontier makes sense if you've got $10,000 and you're making $200,000 a year. It's much more about tax planning, using your benefits, and just getting out there. You know what I mean? You've got all these different areas, the protection planning aspects that a financial planner will bring to bear. Yeah, okay, you still need homeowners or renters insurance, and you still need disability coverage, but I don't think that the protection quote needs are there because you haven't built anything to protect yet. And there's lots of ways, as you know, that a sea of people get around that with insurance. So that's what I meant was much more the bang for the buck, to your point, is there where, hey, if we just focus on these couple pillars, maybe a budget coach is a better idea. Or
you don't need a concierge doctor. You just need a telemedicine guy.
Yeah, absolutely.
You need to pay for Arnold to be your personal trainer. Just go do some freaking push-ups.
There is one paragraph late in this piece that I wanted to focus on because I think we can actually learn from what Robinhood is doing. If Robinhood's good at anything, it is making sure that they make more money. And this is a quote: "Trading commissions are not coming back," says William Trout, director of securities and investments at technology data firm Datos Insights. "Trading commissions are not coming back, and custody offers an easy way to connect with advisors and their affluent clients, many of whom are also self-directed investors," he said. "Robinhood is smartly hedging its bets as it shifts from a purely customer-facing, transaction-centric model to an advice-based business, one that's also business to business." Let me back off this a minute, because if we really parse what he's saying there, OG, Robinhood is, when you take a look at the assets per person that Robinhood deals with, it's not that high. The average person doesn't have that much money. Robinhood now wants to move upstream. And what's interesting is trading commissions are not coming back. I love that quote. So they're going, okay, if I want to get around wealthy people, I'm going to get around people that don't trade as much. And so then I put together, if A equals B and B equals C, well, if wealthy people don't trade as much, maybe trading is not the way that I become wealthy. Maybe there's other ways, because if the vast majority of wealthy people, and Robinhood wants to get with wealthy people, maybe there's something here. I just want to get to an asset base that doesn't need to trade to figure out a way to make money.
Or, I thought what you were going to say there was a lesson for investors, which is, if Robinhood sees that wealthy people don't mess with their money very often, why the heck are you doing it? I thought that was
exactly my point, which is, thank you for interpreting for me.
I was like, let me restate what you just said, because I got a little lost in the forest of Joe's mind, but I came out the other side.
A little foggy in there.
Yeah, it is.
Maybe a premonition toward Doug's trivia coming up. A little foggy. But yes, absolutely. If Robinhood thinks, let's make money in a maybe a better way, in a way that's more sustainable, regardless of whether you're using a financial planner or not, there's big questions around. So what's important this year in financial planning? Certainly, we have the same pillars of financial planning we talked about earlier, and also that you'll see with any financial plan. But Go Banking Rates had an interesting piece recently, 4 emerging financial planning trends for the rest of 2024. And I think, OG, these carry into 2025. First of all, they start off with stock market volatility. We've had a lot of volatility here the past few weeks.
It's an emerging trend?
Yeah.
Volatility is an emerging trend.
Well, there's always volatility, but look at how choppy the waters have gotten, even versus normal times. It's been a little bit more choppy. A lot of it's news-based, right? We're talking about new administration, new things, what's going to happen. I feel like there's a ton of speculation out there. I think that planning in your financial plan that things could be volatile and worried about it ahead of time is a good idea. In other words, what do I do or not do if the stock market goes down? And what do I do, not do, if the stock market goes up? Like, what do I do if things get really volatile? I feel like making sure you got that plan ahead of time is a good idea for 2025.
Yeah. I mean, I hate this bullet point here because it's implying that there is no volatility other times. I mean, most people don't even feel that there is, because it's all upside right now, except for August. The stock market's gone up for 2 straight years, pretty much. And what I think most people don't understand is that that's volatile also. When the S&P average is 10, but the last 2 years it's done 25, that's volatile. But nobody's complaining about it. They complain about the downside of volatility. But I think it's a good idea to have lifeboat drills from time to time and recognize that, hey, if I've got $1 million today, there's a very real chance that I wake up in a year from now and it says 800,000. What do I do? How do I feel about that? And is there anything that happens along the way? And really the right answer is, if your goals haven't changed, your portfolio shouldn't change, even if your account goes down 20%. It's just part of the deal. So take advantage of strategic rebalancing or tax loss harvesting if you can. But otherwise, if your goals don't change, you shouldn't be changing your portfolio.
Oh, come on. It's not.
Sell, sell, sell.
No?
Joe's got a new toy.
Well, then is it?
Buy, buy, buy.
Back the truck up, as they say. What else is on your list of silliness?
Yeah. Well, number 2 is the expansion of AI and personal finance. And you're seeing a lot of sexy hey, let AI pick your stocks. AI knows where the market's going. I love our friend Michael Kitces just had a piece pretty much saying, oh, gee, beware all that. Because as Robert Farrington said on our show, man, the amount of times AI is brilliantly and confidently wrong is pretty disturbing.
A couple of weeks ago, I went and played golf with a bunch of friends, and we have an interesting golf bet that we do in each foursome, and it has to do with putting. Basically, if you make the putt, you get some money. If you lose, you pay everybody else money. Seems simple enough. And it's easy until there's a lot of wins and a lot of losses. And then somebody doesn't have any, right? So it's like, who's paying who and whatever. And so we'd always sit there and try to struggle to figure out who owes who what money. And I said, I'll just put this in ChatGPT. Told him the rules of the game, told him who won and lost. And it goes, oh, everybody pays Taylor $75. I was like, this is awesome. Done, right? So then the next game, we do the same thing. And it goes, everybody pays Taylor 90. And I'm like, wait a second. I did more than Taylor. How come I'm not getting it? And you're like, shouldn't OG get some money? And it's like, oh, you're absolutely correct. Everybody pays OG $90. And I'm like, well, no, Taylor gets money too. You're absolutely correct. Everybody pays Taylor and OG $90. Like, yeah, okay. You can't even get a simple matrix of this very simple game of yes and no. No cost this, yes cost, you know what I mean? So
you can't get the bet right.
I've asked it to say, what's the best asset allocation for the next 20 years? And it's like, you should have 80% of your money in NVIDIA. So, it's very confident.
And the rest in Bitcoin. Number 3 on this list, interest rates are still high. I think this is great for whether it's a trend or whether this ends up being wrong. Because either way, OG, planning on a world where interest rates are high is better than betting on interest rates low. And then you got to deal with the consequences. I like planning conservatively, and I think planning for high interest rates in 2025, kind of the place I want to be.
Yeah. I mean, again, we were all super spoiled in COVID times of 2 and 3% mortgage rates. I mean, when we bought our house in 2015 in Dallas and our rate was 4%, I distinctly remember saying, there is absolutely no way in my lifetime I see an interest rate this low. Lo and behold, it changed. But there's not a scenario where that happens again, absent another COVID scenario. So just flush from your memory the fact that, but I got my mortgage at 3%. It's like, that's not happening again. 5 is the normal, 6 is normal, 8's probably high. 4.5 is probably low. The normal is
7's much more normal.
Yeah. 5, 6, 7 is kind of the normal float between, where rates are. And if you want to have a lower rate, you got to buy down, or you got to, here's a crazy thought, borrow money for a shorter period of time. Oh my God, the horror.
What?
But, or do an ARM. There's a lot of different ways to manufacture that lower rate if that's a desire of yours, but we're comparing it against, it's almost like, when the market goes down, and everybody says the really dumb thing of it's on sale. It's not on sale. The way that I look at it is, it's like if your portfolio was worth $1 million and now it's 800,000, or the S&P was at 6,000 and now it's at 5. I don't look at that as being on sale. I look at that as like a time machine. The downside is you've seen the 6, right? You've seen 6,000, and you're comparing today against this, this other known that you have, and you're like, I lost 20% or whatever, right? But the other thing that you have is you've just entered a time machine. You know where if it went from 6 to 5, you know where it's going. You already know. You get to experience that 5 to 6 all over again. And maybe it doesn't happen tomorrow, or it takes a year or 2 or 5 or whatever it does, but you know that it's going to happen again. It is such an amazing benefit, and everybody gets freaked out about it, but nobody cared when it went from 5 to 6 the first time. That's great. It's like, no. we get to do it again. You know, I don't know. I don't think of it as back to truck up time or, you know, let's buy because it's low. It's just yesterday's price. And you know, today's price, it's like an unfair advantage. You know, it's like if somebody told you what the stock market 100% guaranteed was going to do tomorrow, you could invest that way, right?
It's amazing. Well, and just keeping your emotions in check. Let's say that the stock market goes up from $8, whatever stock you're looking at goes from $8 to $10.
Lumen, let's say.
Let's say Lumen goes from $7.62. Not that I watch it.
Who's counting?
To $12, which is a just stupid, huge gain, right?
Yeah.
It goes to $12 and then it comes down to 10.
Yeah.
You feel horrible about the 10.
Yes.
Even if it just went straight line from 762 to 10, you feel phenomenal.
Yep.
You're like, this is great. And balancing out your emotions there.
And the difference between an individual stock and the overall market is that there is a chance that 10 is the highest it ever goes again, right? It can go from 10 to 9 to 8 to 0.
No.
And not with your stock,
Lumen.
I know.
Not in Joe's sunshiny world.
Not with that bellwether of a stock. But I'm saying like with some companies, they are known to go bankrupt. But when you invest in the overall market and it goes from 7 to 12 to 10, you're like, I've already seen this movie. I know it goes to 12. Like it's unfair. It's not even anyways, don't get me started. I don't understand why people get frustrated by it.
For people just starting out here, full disclosure, which I think we have to make, which is I own Lumen stock. I bought it for the dumbest reasons.
I don't think anybody cares. Or
and then I got really lucky.
Disclosure
We're not
required.
getting turned into the SEC. Nobody's going to turn me in for
with your 11 shares. I think we're safe, buddy.
I have almost 1,000 shares now. So
you dollar cost averaged up.
Wow. He could actually move the market on that stock if he sold.
I can. 4 more shares, Doug. I own the company. Like I got to start declaring every time I buy and sell because I'm an insider. Sir, you own 10% of the company. Oh, hey. Long way to go until we reach that point. Last thing is, and this is a disturbing trend, OG, that you and I have seen over the past year and a half, especially through all the inflationary times. Recent data from Experian found that Americans owe more than $17 trillion in total consumer debt. And that number,
is that all?
That number continues to go north. It just continues.
That's why the economy is booming, baby.
To go north.
Keep borrowing. I mean, you have to think about it that way. That's your contribution to your retirement account. Your contribution is to borrow money, which makes companies profitable, which makes your stock account go up. It's the never-ending money glitch.
Please,
it's the new Stacking Benjamins money glitch.
It's
infinite
the
money glitch. Infinite money glitch.
I found a hack. You know what the hack is? I just keep borrowing. Just keep borrowing.
What did Robert Kiyosaki say? You know, if I owe the bank $100,000, that's my problem. But if I owe the bank $20 million, that's their problem.
Yep. It's their problem.
Yep. Right. You know, it's like it's not my problem anymore. So this becomes your problem.
I'm glad we talked about Robinhood and Kiyosaki in the same.
I know. What a banger of an episode. The thing with consumer debt,
bringing the flamethrower, aren't you?
Hit all the
thing with consumer debt is when you look at it. We were talking about this last week about paying my house off. When you look at it in the context of how much money you have to make, and earlier this week we talked about fire, right? And you look at it in terms of the fire number. How much freaking money do you have to make? How long do you have to work in the year? We're starting January. There's what's the thing that happens in sometime in April? It's like finally you've paid your taxes by the time you get to like April, whatever, so that the rest of the money is yours. Basically, the government gets your money from January through March or whatever. You know what I'm talking about, you guys?
Yeah, I just don't know the term for it, but I know the concept. Yeah.
Yeah, it's just the concept like when you figure out how much money you make, you work the first 120 days of the year for the government. The rest is yours, basically, or whatever. Mm-hmm. But anyways, when you think about it from a debt standpoint, if you have a car payment that's $1,000, I mean, that's pretty high, I guess. Maybe you have 2 car payments that are $1,000.
Not that high anymore, actually.
Yeah. Well, say it's $1,000. And if you're a person that has a car payment, you're probably going to have a car payment kind of forever, right? Because you're the person that you buy a car, you pay for it, and then a few years after that, you buy another car and pay for it. Like it's just this never-ending cycle. And so, $12,000 a year of car payments. How much money do you have to have? How much money do you have to make every year to pay $12,000 a year? You got to make what, $15,000, $16,000 just to pay your car payment. How much money do you need in your retirement account to kick off $12,000 a year for freaking cars? You know, what is that number? It's use that 4% rule, 200 grand. You know, like you have to save an extra $200,000 to just sit in an account, $300,000 to sit in an account to afford your car payments. Like, holy jeebus. I think when I look at consumer debt, when I look at my credit card or I look at car payments or loans or whatever, I look at it in that context. And that's why when I think about the mortgage, when we were talking about this a week ago or whatever, I don't think about it in terms of, well, it's 2.5%. Like, who cares? That's good. That's easy money. I look at it like, dude, I gotta make a load of money every year to pay for this damn thing. I'm tired of doing it. I want to take the stress off. And the same thing with
you're still going to have the property taxes going up. You're going to have your insurance costs still going up.
Well, I got all that, but it's.
No, I'm saying let's get rid of part of the load.
Yeah,
man.
Like,
there's still enough load
it's
already.
That plus the mortgage.
Yes,
exactly.
Yes, preach, man, preach, yeah. OG.
So if you got consumer debt, look, just suck it up, Buttercup. Just do it for like 6 months. It doesn't even
suck it up, Buttercup.
I mean, it just sucks for a short period of time. You don't have to suck for a long time. You just suck for a short time. You just get it over with.
If you want inspiration, by the way, just go back to Monday's episode and listen to Jackie because, man, as we do the Monday after Thanksgiving week every year, when we talk basics, there's a lot of inspiration there to get you rolling on the right track. We will dive more into what's going on in the world of financial planning in the 201 newsletter. We'll have links to everything we talked about on our show notes page at stackingbenjamins.com. Also a link to the 201 there, our newsletter. But if you want to just go right there and sign up for it to continue this discussion tomorrow, it is stackingbenjamins.com/201. And that is the link to sign up. And you know what? That'll also put you on our list. So, you know, when we're traveling, where we got details coming up on Seattle, coming to New York City. I'm sure at some point I will be back in Boston next year at the very least. I know we're coming to those places. So stay tuned because we might be coming to an area near you. Coming up next, the TikTok Minute. We're going to shine the light on a TikTok creator who is doing something original. And actually, this TikTok creator was actually listening to Doug. I'll explain that after Doug gives us today's kind of foggy trivia segment. Not a great day in history.
Hey there, stackers. I'm Joe's mom's neighbor, Doug. And bad news, if you were planning on coming over today, I'd recommend holding off. Joe's mom made her famous chili, and well, let's just say that OG and lima beans don't go well together. Speaking of
lima
fog,
beans in the chili? What is she doing?
It's what makes it famous. Speaking of fog, you'd want to have good health insurance back in 1952 when a lethal fog combination descended on London for 5 days, sending thousands to the hospital and even killing thousands more. Here's the question. What's the term that was created to describe this foggy disturbance? In the basement, we just call OG's outbursts gross, but this is a different name I'm talking about. I'll be back with it just after I beg Joe's mom not to serve chili and to get a gas mask.
This episode is brought to you by Progressive Insurance. Do you ever think about switching insurance companies to see if you could save some cash? Progressive makes it easy. Just drop in some details about yourself and see if you're eligible to save money when you bundle your home and auto policies. The process only takes minutes, and it could mean hundreds more in your pocket. Visit Progressive.com after this episode to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states.
You didn't start a business just to keep the lights on. You're here to sell more today than yesterday. You're here to win. Lucky for you, Shopify built the best converting checkout on the planet. Like the just one tapping, ridiculously fast acting, sky-high sales stacking, champion of checkouts. That's the good stuff right there. So if your business is in it to win it, win with Shopify. Start your free trial today at shopify.com/win.
Did you know Fast Growing Trees is America's largest and most trusted online nursery with thousands of trees and plants and over 2 million happy customers? Whether you're planting fruit trees, adding privacy, brightening things up with flowers, or bringing in house plants, Fast Growing Trees has it all. Even better, they can help you find options that are right for your climate, your space, and lifestyle. Click Order Grow. Every plant arrives healthy with the Alive and Thrive guarantee straight to your door. So if you're ready to get planting, this is the moment. Right now, they have great deals on spring planting essentials, up to half off on select plants. And listeners to our show get 20% off their first purchase when using the code WWO at checkout. That's an additional 20% off. Better plants and better growing at fastgrowingtrees.com using the code WWO at checkout. Fastgrowingtrees.com, code WWO. Now's the perfect time to plant. Let's grow together. Use WWO to save today. Offer is valid for a limited time. Terms and conditions apply. Go to growingfasttrees.com for details.
Hey there, stackers. I'm the guy who enjoys breathing and who will not pull OG's finger, Joe's mom's neighbor, Doug. Back in 1952, a combination of smoke and fog descended over London, causing a bigger disturbance than that time Joe had 3 helpings of ice cream in a single setting. That was disgusting. But in this case, sadly, the fog was fatal and gave way to a new term by combining the words smoke and fog into smog. Yeah, I figured you could probably do the math. You could do the math there. I figured you could. And now let's get back to 2 frequent smoggers on this podcast, Joe and OG.
It's sad, Doug, how little we know about history, because that sounds like just an absolutely horrible time. I knew nothing about that until I watched The Crown.
The Crown, yeah.
That was my mom's birthday. That's when she was born, was during that time.
That day.
Yep.
Wow. But not in the
Not
smoke.
a great time in history, and definitely a time you wanted to make sure you had some health insurance, although it sounds like that wasn't even enough for some people. Hey, let's dive into the TikTok minute. Where do you go? Hey, smog killed a bunch of people. Let's pivot. Away, abort, get done, get out of that segment. TikTok minute is where we normally shine a light on a creator who is either doing something brilliant or air quotes brilliant on TikTok. Today, though, I was sent by stacker Julia. Julia sent me a discussion with Doug and his banker that we actually found on TikTok. Now, the voice has been changed with AI, but Julia assures me that this is Doug.
This ought to be
and
good.
Julia says the thing that Doug and his banker were talking about, buying a new boat, huh, Doug? You're buying a luxury motorcraft.
Yeah, talk about a great investment, boats.
Yeah, this is Doug buying a yacht with all that big announcer guy money. This is Doug and his banker.
Take a look at the numbers.
Okay, totally. Yes.
Okay, so that's 17 million.
Mm-hmm.
So you have to put down 3.4 million. You have to put that down now in cash. And then your monthly payments are going to be 77,000 plus maintenance and tax. So basically $80,000 a month plus the 3.4 million that you're going to plunk down right now, okay?
Mm-hmm.
Okay, so now let's compare that to your current assets. Currently, in savings, you have $7,000. Let's take a look.
Apparently, that's not enough.
I didn't get the tone of his voice there. He made it sound like a bad thing, and I don't know why. I mean,
how'd they get the microphone in that room?
I might have left my phone on record there, but because I wanted to be able to go back and take notes. I just don't understand what he was trying to tell me when I only had said it's a lot.
You're going to pluck out $3.4 million now and $80,000 a month.
Yeah, I just take the 3.4 as a write-off. It's just a write-off.
That's how you afford it. You just write it off.
That's what I've heard. Companies do it all the time.
It's a write-off.
I've been watching the new show about Ryan Serhant's brokerage firm in New York City on Netflix. I love these real estate shows. And somebody, in I think episode 5, had a budget of $10 million to buy a place in Lower Manhattan. You couldn't find the type of place they wanted. 4,000 square feet, all on a single floor, as you do.
Right.
And also wanted to make sure that there was privacy, because these people like their privacy. So no tall buildings around them, because there's very few in Lower Manhattan. This broker finds a place for $22.5 million and presents it to him. Their budget's $10 million. And so they get done and the guy's like, yeah, this looks great. So how much? And she goes, well, that's the bad news. It's just over double what your budget is. You know how this story ends? They say yes. The people actually go with $22 million.
There's a show, I think on, I don't know, one of those HGTVs or whatever, where the people make a list of all the stuff and then they go do the tour and they're like, how's this? They're like, oh my God, open floor plan, 5,000 square feet with a pool on 2 acres. This is exactly what we wanted. You're amazing. He's like, yeah, your budget was 500. This is 6.8 million.
Right.
So let's go ahead and readjust our perspective here. Cause
I like that one better. Let's just give you a little slap.
Or my other favorite is it's like, he's a florist and she's a dance instructor and their budget is 19 million. And you're like, wait, what?
Yeah. Not that you can't make loads of money in those professions.
I mean, maybe you can, but let's meet Jack and Jill. He's a plumber, and plumbers do make a lot of money.
Don't say that. Yeah. Plumbers are making more than we are.
My nephew leaving the Navy, going into plumbing, and got a great start, learned a ton in the Navy, working in plumbing in the Navy. And now he's on the market, and this kid's going to make more money than it's going to make so much money.
What's funny is a lot of times I've known stories with that where they'll say they're leaving and then the Navy goes, well, what are you going to do? Like, I'm going to go do the same job I was doing. I'm just going to go make 10 times the money. And they go, how about we give you $100,000 bonus to stay for another 4 years to even out the cash? Cause we need your skill. That's why we taught you.
Wow.
Yeah.
I'll do that. They need podcasters. Navy need podcasters.
I would love to see Joe in the Navy. That would be comical with that little hat off to the side and your little white unis, like a little national defense ribbon.
That'd be pretty badass.
I've seen him in that.
It'd
be pretty amazing. I wore a uniform in college for a couple of years.
Oh, I know. Was it a Navy uniform?
It was not. No, didn't make it that far.
It was a little Bo Peep uniform.
It was.
You wore for a couple of years.
And scene. No. Hey, because we probably can't help Doug with that transaction, let's help another stacker who said, you know what, I better call Saul. C-Hi and OG. This is where we shine the light on a stacker who has a little call for help. And today we're going to help our buddy Jordan. Hey, Jordan, what's going on?
Hey, Joe, OG, and neighbor Doug. I'm calling to get my free t-shirt and apply to be one of Doug's Secret Service agents. Anyways, I'm 32 and recently passed the mythical 100K invested across my retirement accounts and a taxable brokerage.
Woo!
But in my pre-stacking Benjamin days, I tried to pick some single stocks, which represent about $10,000 out of the 100,000. They've done okay overall, but I've just been going in indexes since then. My question is, when projecting out the future value of my portfolio decades from now, people say to use an 8 to 10% rate of return for those compound interest calculations. But does that only apply when it's in those like main index funds like the S&P 500 or total stock market? And then I should just use 90K as the starting point for those compound interest calculations? Or can I assume the same with the single stocks as long as they just don't go completely belly up? I'm just trying to gauge where I stand and if I should wait till I have 100K just in index funds before I start celebrating. Thanks.
Oh, Jordan, great question. And you know what? Start celebrating now, brother.
Yeah. Cash is cash, bro.
Getting there. It's getting there. So cheers to you. Raising the mug to Jordan. Nice job. Oh, gee, there is, a big difference to his point. I mean, over long periods of time, those index funds, not 100% predictable, but I think a lot more predictable than what we think NVIDIA is going to do the next 10 years.
Yeah. Well, asset classes in particular, right? Because we've got 100 years worth of data there. And the beautiful thing about investing in an asset class as opposed to picking individual stocks is Bezos has come out and said, I don't know, within the last 5 years that he doesn't believe Amazon will be a company in 20 years. He's like, I just don't think it'll be around. Something will be better, bigger, faster, stronger than this, and we will cease to exist. So do you want to ride Amazon the whole time? Or do you want?
Can you imagine that, by the way? What you just said, I can't imagine Amazon not being around. But then I go back to 1990 and I'm like, could I imagine Amazon doing what they do now?
Yeah. The beautiful thing about buying an asset class fund or an index fund is that as they fade away, it just goes away. It's worth less and less of your portfolio, and you're owning all the things that are doing well as the things that are not doing well, but it evens out. My question would be, why would you continue to hold on to the stocks if you didn't believe that they were going to perform at the same rate as your the rest of your portfolio. There could be some tax issues potentially, but that would be pretty minuscule, unless you make a bunch of cash. Capital gains taxes are 0 for a long time and then 15% for a really long time. So maybe you got to pay a little bit of capital gains taxes to get out. But if you're holding stocks that you believe are going to perform better than the average market return, then I don't know why you wouldn't use the same rate of return in terms of your calculations. The thing I would do, however, is I wouldn't use the 10 number. The S&P average is 10, but I think it's a lot more prudent to be more conservative than that and force yourself into higher savings rates and then be surprised on the back end. So I love using 7.5. I love using 8. Get above 8 and I get a little squirrely because, human behavior is there and there's reasons why it won't go to 10.
Jordan, this is exactly what we talked about earlier when we were talking about betting on interest rates staying high.
Yeah.
Because if you bet on them staying high, you're going to high five yourself when interest rates come down. If you bet on them coming down and they don't, now you've got to do extra work that you didn't plan on. And much like we talked about riding that emotional roller coaster with stocks, OG, the emotional roller coaster of, I got to do all this extra work versus I went in planning on doing extra work and now I don't have to do as much.
Yeah.
It's much, much better to plan on doing more work at a time.
Yeah. So in my plans, I would use 7.5 or 8. If you don't have any serious reason to keep those individual stocks, I might consider transferring those into your asset class funds or your index funds, and then you don't have to worry about it. And then you can use your 7.5 for all of it or 8 for all of it and be done. If you like the stocks and you go, I'm going to keep this as part of my portfolio, totally fine. Evaluate it every year to make sure that it's doing what it's supposed to be doing. And pretty soon the reality is that 90 of the 100 is going to grow so much faster, even against the 10. The 10 would have to grow so much faster than the 90 to make up the loss of the fact that to make up a meaningful amount of the overall, So like if you look at your 10 and you say, well, it's going to grow by 10%, that's 1,000, right? If I look at my 90, it's going to grow by 10%, that's 9,000. But going to 11, if you have a year that's 11, your 90 grows by 9,900. So your 10, if it stays flat, you're still even money. So my point is that, is the juice worth the squeeze here on the excess risk that you're taking for the 10, the $10,000 there to make a meaningful return on the extra 10? It has to grow so much faster than the market that I just don't know that it's worth it. I was just having this discussion with a client a couple of weeks ago. They just brought something up about Tesla as an example. And I said, sure. So if you want to invest in Tesla, fine. But what does it have to do to have a mark on your portfolio? So you have $1 million in your account. What do you want? How much Tesla do you want to buy? Oh, maybe I'd buy 50,000. Okay, cool. So we know that normally that 50,000 is going to grow by $5,000, right? 10% or $4,000, 8%, pick your number. Doesn't matter. So what does that 50 grand have to grow to make it an outsized return against the risk of Tesla going bankrupt and you going from 50 to 0? Does it have to double? Does it have to go from 50 to 100? Does it have to triple? Does it have to go to 150? It's like, well, if it doubled, that'd be awesome. Okay, cool. So doubling is your goal. 0 is the downside. So in the big picture, the grand total of all the money you're going to make here is 50 grand. I mean, against $1 million, you see what I'm saying? Like it's not 0. $50,000 is a lot of money. I'm not saying it's not. I'm just saying against $1 million, you should be making $100,000 a year anyway. And so
you're also not making 50 grand because that's the 50 grand is not even the premium. If the 50 would have made 5 on its own, the premium truly is 45.
Right. Exactly. And so you finish the year and you go, I'm super excited I own this individual stock for 5% of my portfolio. What did it get me? Got me an extra 40 grand. Okay. I mean, it's not 0. That's definitely $40,000, but it's also a chance that 50 stays and doesn't do anything. I know another investor that took a bunch of money, bought into a really small company that he was very confident in the long run and got bought out. Was like literally, the company was, hey, we're not interested in having investors anymore. Here, let's buy you out. And he's like, well, wait a second. I put this $500,000 in this small company because I believed in the long run, the returns were going to be outsized. And they're like, cool, but we don't want investors anymore. We're going to get you out today.
They will be outsized, but not for you.
Yes, they're going to be for us because we're taking your money off the table. And they paid him out and he made a return, but he didn't make a return equal to even the market. He's like, it would have been better for me just to put my money in the freaking S&P over the last year. So I think we get wrapped up too much on these, these little teeny tiny decisions and don't look at the outcome and what's the best outcome that can happen or the worst outcome, and then go, is this really worth it? Now, there are some circumstances where you're an employee at a pre-IPO company or you're at a startup and your boss goes, hey, we're going to give you 50,000 shares of this company at 10 cents a share. You're like, all right, cool, whatever. Right. And it's going to cost you some money to get in, $5,000, $10,000. To me, that looks like a good ROI potential, right? Because at 10 cents a share, if it goes to $1 or $2 or $5 as the company grows, this is a profound amount of return versus already a publicly traded company. People going, used NVIDIA as an example, Joe, people going, well, I think NVIDIA is going to double. Okay. So is the S&P, by the way. It's just who's going to do it first. And is the juice worth the squeeze on the volatility associated with the individual stock? The time to buy NVIDIA was freaking 7 years ago, dude. Like, that's when you should have put all your money in NVIDIA. But you know why you didn't? Because that was
nobody wanted anything to do with it.
It was a dumb idea. And if anybody would have said to you, I got an idea, let's put a bunch of money in a company that's pretty much teetering on the edge, but I have a feeling that their graphics cards are going to be amazing sometime in the future, you'd have gone like, okay, yeah, no, I'll just buy my index funds.
I remember so many years NVIDIA just being the company you did not want in your portfolio.
So why play the game with 10 grand when 10 could turn into 12, 14, 20, or 8, or not 6 or 4 versus the known outcome of, you can't pick the returns every year, but I'm pretty confident the S&P is going to average 10. It has for the last 100 years. It probably will for the next 100.
Now, but Jordan, if you enjoy the individual stock investing, and we've talked about how each of us enjoys some of that ourselves, just don't bet on that 10 grand for your goals. Go ahead and count it when you're high-fiving yourself that you got to 100. But maybe when you talk about the certainty of reaching your goals, you just take that money off the table.
Plan on 90 instead of 100.
Yeah, don't get me wrong. High-five yourself when you reach the milestone based on the whole thing. But for your planning purposes, take it off the table. And I think, you get that nice midpoint. I certainly have enjoyed, to OG's point, my 11 shares of Lumen stock. Yeah. They're going to make me super wealthy. Super fun.
For sure, maybe.
Probably not, but it certainly is a good time. Jordan, thank you for the question. Of course, we are going to send you some swag for calling in. We do that with all of our stackers who call in, stackingbenjamins.com/voicemail. If you've got a question for OG, and certainly if your question isn't just, hey, what do I do about these stocks? It's, how do I make my plan go? And I need a better plan in 2025 than I had in 2024. Well, guess what? OG and his team are taking clients. So head to stackingbenjamins.com/OG. And that's the first step. Get you on their calendar to see how they can interface with you to get the plan rolling in 2025. Going to have trouble saying that. 2025 already.
Wasn't that Buck Rogers or something? Isn't there some famous, like, super futuristic movie that was in 2025?
And we're there.
Yeah.
And boy, it looks just as cool being here.
Speaking of something in the future, I just saw a thing on Reddit that apparently John Malkovich, did you guys see this? Made a movie called 100 Years. And no one knows what the movie is about except the people that were in the movie. And it's sealed in a vault that is not going to be opened until 2115. So they made the movie in 2015. And it's going to be opened in 2115. They've got the release dates like November 18th, 2115 in theaters.
You want to talk about a long-term investment, because the people who financed that movie are banking on that to have huge dividends for their their offspring.
For their great-great-grandkids.
Right. And probably will, frankly. I mean, I don't know. It's a little bit like, was it Boyhood, Joe, who's the filmmaker that took like 20 years to film? Because he used the same actors for that whole time of their lifespan.
Richard
Linklater.
Richard Linklater.
Yeah. It had that wow effect. And we're like, I want to see the movie that used the same actors from when they were little kids to when they were young adults. I mean, that's a great concept, but is that going to be enough to justify what you spent making a movie in 2015?
Yeah, I got my RSVP, by the way, for that open. I had to send my regrets. I will not make it.
I will be dead for 80 of those.
Invited to the red carpet.
Because I'll be taking a nap, a dirt nap.
That is super cool. Yeah. Plus, with actors that none of those people in 2115 will have ever heard of or know.
No idea.
Wow.
Like, this Malkovich guy. I got to look back and see that guy. That's incredible. Time, I think we already did it, but time to journey out onto the back porch. This is where we talk about community stuff coming up. I'm not sure if New York City has tickets, probably not, but stackingbenjamins.com/NYC. If you want to hang out with OG and I, Paula Pant, Doc G, Nick Majuli, Jillian Johnsrud, star-studded lineup, stackingbenjamins.com/NYC. But even bigger, Retire Meet in Seattle. Today's the first day we're announcing this on the podcast, so you can make sure you get in. We have discounted tickets. Tom of Tom and Don fame over on the Talking Real Money podcast. This is their retirement one-day conference in Bellevue, Washington on February 8th. Even better pricing than their early bird pricing tickets for our stacker friends. Thanks to Tom and Don for doing that for us. But it's Retire Meet, retiremeet.com. And we're going to have a meetup too. More details in January on our Stacking Benjamins meetup. So if you're in the Seattle area, circle that weekend, either join us at Retire Meet. I'm sure Paul Merriman will be there. Our good friend, Paul, good to see him again. And of course, Don and Tom, who are the awesome host of the Talking Real Money podcast. So thanks to them for inviting me to talk. And I'm going to be speaking about what the happiest retirees know, which is going to be fun-filled. Probably the best part of the conference, OG, I would say.
Probably. For sure.
Yeah.
Maybe.
For sure. Maybe. That's going to do it for today. Doug, you've got us from here, man. What should we have learned on today's show?
So what's stacked up on our to-do list based on what we learned today? First, take some advice from our headline. While you want to follow the trends in financial planning, the best plans are always evergreen and will work no matter what hot topic is top of mind today. Second, do you want returns that are more reliable? Because the standard deviation on an index is easier to predict than a single stock, stay diversified, and then you can project away how wealthy you'll be in the future. But the big lesson? I know that fog in London was no laughing matter, but neither is OG when he wears that Drakkar cologne from Walmart. God, next time, OG, just use a manure spreader. It'll be faster. This show is the property of SB Podcasts, LLC, copyright 2024, and is created by Joe Saul-Sehy. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.
OG rocking the Tom Ford. Let's get real.
Drakkar was so great.
Rocking the Tom Ford. Speaking of rocking, how about this, guys? This is news from AP. I think we're in the wrong business because there is...
You could just end that sentence there.
Correct.
And seed. That's the after show. Walk into any supermarket, you can generally buy a banana for less than $1, but a banana duct taped to a wall, well, that might sell for more than $1 million at an upcoming auction at Sotheby's in New York. The yellow banana fixed to the white wall with silver duct tape is a work entitled Comedian by Italian artist Maurizio Catalan. It first debuted in 2019 as an addition of 3 fruits at the Art Basel Miami Beach Fair, where it became a much discussed sensation. Was it a prank? Commentary on the state of the art world. Another artist took the banana off the wall and ate it. Backup banana was brought in. Selfie-seeking crowds became so thick, comedian was withdrawn from view, but 3 editions of it have sold for between 120,000, 150,000. Now, guys, they think it's going to fetch between $1 million and $1.5 million. Banana duct taped to a wall.
I love that they had a backup banana. I've had that job description before.
Well, you're
a previous career.
Are you the fluffer?
Yeah.
What movie is that? That's a Christmas movie. Love Actually, right?
Yes.
Isn't it Love Actually where they're fluffers? Yeah. Setting up the camera work. It is that time of year.
Where do we go from there?
I was wondering about this banana. So here's what happens if you buy this thing. You actually get a certificate of authenticity that says that you can use different duct tape and a different banana and put it back on the wall, because what you're really buying is a certificate that this is the intention of the artist.
Wow.
Oh my God. That reminds me of another similar story I just saw in the last month, 2 months. Somebody sold an invisible sculpture and you got a certificate.
Sculpture.
Yeah. This is a real thing. Like from an art gallery, and you just got the certificate.
You know, these people in the art world, by the way, overthinking this, right? They're like, Catalan premiered the work at an art fair visited by well-off art collectors where a comedian was sure to get a lot of attention on social media. That might mean the art constituted a dare of sorts to the collectors to invest in something absurd, this one collector said. If comedian is just a tool for understanding the insular, capitalist art collecting world, Cooper Jones said, it's not that interesting of an idea, but she thinks it might go beyond poking fun at rich people. Catalan is often thought of as a trickster artist, she said, but his work is often at the intersection of the sort of humor and the deeply macabre.
Please stop.
Yeah.
He's quite often looking at ways of provoking us, not just for the sake of provocation, but to ask us to look at some of the sort of darkest parts of history and of ourselves. They go into the history of the bananas and the people that had to harvest the bananas.
Oh, for God's sake.
And
Doug's mom harvests bananas all the time.